Batsplaining. And I'm back. You're welcome. Today we're talking about capital gains tax and alternative minimum taxes. So capital gains, it's part of the way that we rich people pay lower tax rates than you. And alternative minimum taxes are the government's way to try to make us pay more so that it's fair or whatever. So, capital gains, that's a gain made from the increase in value of something that you own, an asset, or the dividends that you receive from that asset. There's two types. There's short term and there's long term, and they are exactly what they sound like. If you've held it for long enough time, it's long term. If you haven't, it's short term. Short term capital gains are treated as ordinary income. Think day trading on stocks or crypto. Whereas long-term capital gains, they get special tax treatment. Heck, they even get their own special tax brackets. Yay! Now, typically you have to hold these for at least a year. So think of buying a house, living in it for a few years before selling it. Now, you're only going to be taxed on the profits, not the sale price. Thank goodness. So you're going to take the sale price and subtract out what we call your cost basis. That's how much did you pay for it. Not just the price, but also any commissions, selling fees, or even upgrades. So if you're selling a home, don't forget to include that sweet kitchen and that jacuzzi that you put in. Nice. Now, that profit will be taxed as long or short term depending on whether you held it long enough. Now, the dividends, again, that's the distribution of a company's profits to its owners or shareholders. If you own the stock, the ETF, or the mutual fund, you are an owner, and therefore you have a right to a portion of those profits that are being distributed. Qualified dividends are taxed as long-term capital gains, whereas non-qualified dividends are taxed as ordinary income. What determines the difference? Well, it's holding period, entity type, the base of operations of the company or entity, and the investment type. You kind of have to look it up on an investment by investment basis. But by and large, most U.S. companies give qualified dividends. Long-term capital gains tax brackets are slightly different than your regular tax brackets. First off, there's only three. A 0%, a 15%, and a 20% bracket. Yeah, that's right. There's a 0% bracket. That's awesome. And the income ranges are huge. So what you're going to have to do is first take your taxable income and subtract out your long-term capital gains. Remember, like the regular tax brackets, think of it as a series of buckets. When you fill up the 0% bucket, it overflows into the 15% bucket. And then into the 20. Pretty simple. So, let's say that you're married and you have a taxable income minus long-term capital gains of $50,000. Well, we're going to pour that $50,000 straight into the 0% bucket. Then we're going to pour in our capital gains. Let's say we have $50,000 in that as well. Okay, well, $46,700 is going to fill up the 0% bucket, and the remaining $3,300 is going to flow into the 15% bucket. So, you paid 0% on $46,700 and 15% on $3,300. That's not bad, especially when you consider if you didn't have this special tax treatment, you have had to have paid 12% on $46,950 and 22% on the last $3,050. That's a tax savings of $5,810. Good job. Now, I want to draw your attention to the fact that if your taxable income is only from qualified dividends or long-term capital gains, and that income doesn't exceed the first bracket, that's $48,350 if you're single and $96,700 if you're married, you will pay $0 in tax each year. Sounds like the sweet spot for Nepo babies to me. Let me give you an example. You're a single person and you make $1 million from working your butt off at your job. And I make $1 million in qualified dividends off of my bat-tastic stock portfolio. You are literally going to be paying almost twice as much as me in taxes. even though we made the same amount of money. How, you ask? Well, Social Security is going to be taxed on your first $176,100. Medicare tax is going to be taxed on the full $1 million. Additional Medicare tax is going to be taxed on earnings over $125,000. And then you get to funnel your income through the regular tax brackets with a top bracket of 37%. Your total taxes are going to be $365,000. That's an effective tax rate of 36.5%. Ugh. Whereas I only have long-term capital gains. Remember, the top tax bracket's only 20%. And Social Security and Medicare aren't charged on unearned income. So my total tax is going to be about $195,000 with an effective tax rate of 19.5%. I saved so much money. It literally pays to not work, which doesn't sound fair. But where do you think politicians and the people who fund their campaigns get their money from? I know there are politicians that are saying they want the rich to pay more, yeah, but the solution they often put forward is to raise the income tax rates for those higher income earners. Make the rich pay, they say. But I want you to note, what they said was income tax rates, not capital gains rates. In the example above, you would be paying even more taxes, while my taxes would stay the same. Ugh. That's like being rickrolled by the Joker, but it costs you money. A lot of money. You paying almost 2 times more than me is bad, but there are ways to even pay less by having tax-exempt income, large deductions, etc. Thus, the alternative minimum tax was created to limit some of those strategies. Notice I said limit some. Alternative minimum tax, also known as AMT. Yes, I hate acronyms, but I also hate alternative minimum tax. I also hate saying it, so I'm not going to say it anymore. AMT was designed to prevent high-income earners from using tax deductions, credits, and preferential tax income streams to pay significantly lower taxes, even to the point of not paying any at all. The idea is that it establishes a minimum tax rate that everyone pays so that everyone pays at least a fair share. AMT is almost like a completely different tax form. You have to literally recalculate almost everything. We're going to go back and add some of our forms of tax-exempt interest back and remove some of our deductions. We're then going to take our new AMT income and take out the AMT exemption and run the numbers through an AMT tax table, which is different than the other, and it has a rate of 26 and 28%. You're going to pay whatever is higher, the standard method or the alternative minimum tax method. As I said earlier, AMT doesn't make all rich people pay more taxes. The example above with qualified dividends is going to remain the same, but it could be worse. If I had $1 million in government obligation municipal bond interest, my tax could be 0 for both the Fed and the state. It's crazy. Now, why would the IRS allow someone to pay $0 in taxes? First, you need to understand what a municipal bond is. It's a loan made by a state or local government. And governments love to scratch other governments' backs. It's like a big back-scratching fest. It's gross. It's a way for the federal government to subsidize state and local governments without directly allocating budgeted funds. And we know how good they are at balancing their budgets. And hey, what's the difference between allocating budgeted funds that came in and just not requiring the money to come in at all? Well, accountability, that's what. We have no tracking for where this money is going. We calculate it in aggregate across the country, but we have no idea whether particular states are receiving far more of these deductions than others. That seems like a problem. But if you want to know the real reason why the federal government's okay with people paying zero taxes, it's because high-tax states tend to issue far more bonds. The bonds lower the federal taxes for the constituents, which makes living in those states more affordable, which in turn helps politicians get and stay elected. See how it always comes back to that? Ugh, they're gross. All right, well, that does it for our discussion on income-based taxes. We are going to take a break from taxes. We'll continue value-based taxes and death taxes another time, but I need a break. Why, you ask? Because I've covered what you need to know for tax season, and honestly, I couldn't feel more gross about it. Ugh. I'm gonna go shower. Batman out. Thank you so much for watching this video and for supporting all of our channel. Please like, subscribe, and share this video with a friend. Alright, bye for now.